the bears. What we're going to do in this bearish video is we are going to take my bullish bias and respond to what some of the bears are saying. We're going to talk about BlackRock. We're going to react to video from a chief economist interviewed by CNBC, and we're going to see what people think about the terminal Fed funds rate. We are going to look at what the Financial Times thinks about the probability of higher rates and how much higher. And we are going to look at some of the pain presented by T.S. Lombard and their bearish opinions. So, if you are a bear, you want to watch. If you are a bull, you want to watch. And if you are a human, you want to take a look at the St. Paddy's Day coupon, dare I say, link down below for the programs on building your wealth. Lifetime access to the course member live streams, access to all the beautiful content and perspective on building your wealth, whether it's through stocks, real estate, being an entrepreneur, being employed, how to make more money, tax benefits, LLCs, risk liability, everything, and Q&A with me. Take a look at that linked down below. Let's get started. BlackRock and Mr. Rick Reeder thinks it is reasonable that the Federal Reserve will easily get to a 6% terminal rate. Markets are presently, at the time of this recording, pricing in a 5.65% rate. And now BlackRock believes it is not only reasonable to get to 6%, but also stay there for an extended period of time, potentially as long as a year. The probability of a half-point increase from the Federal Reserve is now sitting as high as 73.5%, according to CME FedWatch tools. That is not great for the March 22nd meeting, and it is a big boon to the bears. Unless, of course, we get 25, and if we've been pricing in bearishness, then that means moon. Okay, maybe not quite moon, but it would be positive. Anyway, it does show that the 50 BP hike is very much on the table. BlackRock is really comparing the U.S. to a chemical like polyurethane. Now, I think this is sort of a weird comparison, but he says markets can be stretched, bent, and stressed and flexed without breaking. And really, a 6% rate shouldn't break our financial institutions or our financial systems, which are very strong. So while it's bearish to argue for 6%, he's really saying, like, the odds of us really breaking something by going to 6%, not that high. Now, it's also worth taking a listen into what this particular interview here from CNBC I think is pretty fascinating. So let's jump into this here. Hey, this video is brought to you by me. My courses on building your wealth are linked down below, where you can learn everything from tax benefits to investing with an LLC or not using an LLC, insurances, how to negotiate with real estate agents and vendors and contractors, or even your boss. Build more wealth by understanding the perspective of what you're not taught in school. All linked down below, extremely affordable prices, and you can now use the St. Paddy's coupon linked below. And we'll listen to this together. Okay, ready for this? Here we go.
What we're missing right now is some guidance that says how much is going to be enough. Because Powell has clearly said where we are, where we were telling you we're going is not enough. And I think the one thing that Steve and other people haven't mentioned is the guidance that the Federal Reserve report itself gave us. It said that given the kind of policy rules that people have been using to assess different types of policies, we need rates somewhere on the order of 6.5%, 7% to get enough of a slowdown in the economy.
I just like to say what the Fed is talking about is this Taylor rule. The Taylor rule, as you can see on screen here, adjusted for current conditions, suggests a Fed funds rate closer to 7%. This is basically, the Federal Reserve has about 4 or 5 different versions of the Taylor rule they use. And the Taylor rule really says you could be at a terminal rate of 5%, you could be at a terminal rate of over 7%. And it just depends on which measure of the Taylor rule you're looking at. I don't know how much it really matters. Back in the COVID pandemic, the Taylor rule actually told the Federal Reserve that they should go negative. So when you hear Taylor rule, think about it like a suggestion. But I would give more credence to what the Fed is actually saying, which is, look, hot jobs, hot CPI report, rates go up. Softer expected, 25 and pause sooner. Simple. We'll see. Let's keep going.
Get us back to 2% inflation. Those numbers are not even on the table right now. And I think the message is yet to come. And we might actually see if the disinflation story disappears on us and the economy actually is hotter than we thought, we may be seeing 6 and 7% numbers between now and the middle of the year.
Yeah, Steve and I both thought we were just talking to Professor Taylor about this not a couple of days ago. I think he was at 6%, Bill, but either way, it seems, let's talk about kind of the yield curve inversion. The 10-year yield at 4% now, I have to think every time I say these numbers because we've been whipsawing around so much. So you're saying we're going to 6, maybe 7% on the Fed funds rate. The 10-year is now at 4% and not going back to the highs we saw in the fall. Have we started the process whereby the higher the Fed funds probability goes, the lower the 10-year yield might go because it's so concerned about where that growth trajectory is taking us?
One of the things to keep in mind is that the Fed is not focused on the inverted yield curve. They're focused on what it really means for the economy. If we have a slowdown in inflation, people really adapt their expectations, adapt their behavior, and we get the kind of soft landing they're hoping for, we have lower 10-year rates. But if we have a crash and a hard landing, we also get the lower 10-year rates. The Fed itself, of course, prefers that soft landing, and they're hoping that through this jawboning and early jawboning, they're going to be able to get people to change their behavior early enough so that we avoid that hard landing. But the inversion of the yield curve gives us two scenarios, and which scenario is going to be depends.
Let me just pause there before he talks about the two scenarios. What's really important to remember about the 10-year yield curve is the 10-year yield curve crashes housing, right? Or the 10-year yield. The more it's around 4% or higher, the more pain you have in real estate. Now, the Federal Reserve to some extent wants real estate to soften because, as Robert Shiller tells us, the wealth effect is most affected by real estate, which means if real estate values come down, people finally stop spending money. What has the Fed always told us? They want to control demand. By reining in demand, they can rein in inflation. They cannot solve supply chain problems. They can only fight demand. The easiest way to do that is crush housing. So in my opinion, the more the Fed teases the idea that we're going to go higher for longer, the higher the 10-year goes. The higher the 10-year goes, the reason it goes up is because people think, well, if we're going to go higher for longer, then maybe I should wait to buy bonds. Less people buying bonds, higher yields. Higher yields, more pain for real estate. It's simple. The only way that 10-year goes down is when, yes, either we are in a recession and the Fed has accomplished getting rid of inflation, or we're going in for that soft landing and inflation is going away without a recession. But until then, the more the Fed says higher, longer, higher, longer, higher, longer, the more these 10-year Treasury yields go up, the more pain you have for housing. In my opinion, it's very simple. It's very clear. Let's keep going.
Upon how credible the Fed statements are and how much Wall Street takes it to heart.
Probably one of the worst pieces of news, Steve, this week was the unit labor cost and productivity report, or maybe it was last week. But when it shows that for the quarter, unit labor costs, I think we're still 6.5%. Productivity is now falling. So it's now showing evidence of labor hoarding, that firms are just reluctant to let people go, which means inflation is higher for now than it otherwise would have been, and that we could end up seeing more hikes and then a deeper downturn resulting in the next, I don't know what the time frame is now, 6, 12, 18 months. I mean, this is going to be a long period of waiting for these conditions to fully set in.
Kelly, I've given up a lot of my optimism here, but one thing I've not quite given up just yet is my optimism on productivity. And we can go through that. And I think you and I probably should do a segment on this down the road. But right now, there's a lot of volatility in the productivity numbers because we had this surge in productivity at the beginning of the pandemic when some of the lower wage and lower productivity workers were let go, and now they've come back. So I'm not quite ready yet to give up the ghost. I think we've maybe had some improvements in productivity from different business processes that have come out of COVID. So I remain optimistic on that front. I don't think we're quite giving that up. What does concern me, though, is the issue of whether or not we have enough workers in the workforce. And that was discussed. And I think that we are still several million short of where we should be relative to having.
And quick note there. This is actually where my talk about women coming back to the workforce from that Wall Street Journal article is really important. We talked about this idea that a lot of women are stopped working during the pandemic because of childcare needs or otherwise, or fear of COVID, because women are more represented in leisure and hospitality and travel and healthcare and education. And these really affected by the pandemic. However, those folks now fearful that their spouse or otherwise could be losing their job in manufacturing, construction, or tech, might end up seeing themselves go back to work to help prop up their household's ability to sustain during these expensive times and difficult times, which that would actually put downward pressure on the sort of labor rate of inflation, downward pressure on a wage price spiral. Increasing the supply of labor is a phenomenal way to ensure that we don't have to get Paul Volckered. But, it certainly does indicate, going through a little bit of a tougher time. But, hey, if we could fill those jobs, we can remove that labor tightness. Fantastic. The Federal Reserve's that much closer to a soft landing.
Workers to do the job.
And, I thought it was interesting, Bill, he is getting asked now more about pockets of the economy where we have problems. We'll talk about this later, but commercial real estate was one of them. And just this idea of, when Warren pressed him, and he tried to say, we don't think we have to have a worsening labor market to bring inflation down. But I'm not sure that's true, because it's now unit labor costs that are driving inflation higher. This is not about the supply chain anymore. This is directly an issue of the tight.
See what Kelly's saying here, right? The labor cost is the problem. It's labor cost inflation is the problem. How do you solve labor cost inflation? You increase supply. Well, we are seeing a surge of supply. The leading indicators, no matter what that jobs report says tomorrow, the leading indicators are telling us the supply of labor is surging, regardless of whether that's women or men. Look at the earnings calls from companies, whether it's Lyft, Uber, Chipotle, Starbucks, right? We've gone through this before. Don't want to sound redundant. The leading indicators are saying the supply of labor is rapidly expanding.
It seems unavoidable.
Well, Kelly, you have to watch out that the unit labor cost is an aggregate number. There are some companies that are really doing quite well in keeping their costs down and changing their business models and using technology to make workers more productive. Other parts of the economy have lagged behind on that. And so you have this big spike in unit labor costs, in part because we are seeing the flip side of the huge downward drop in unit labor costs at the beginning of the recovery. But one thing you have to keep in mind is that the disinflationary forces are still in place that going all the way back for the last 10 years, because technology and the changes in globalization are changing the way business models are going about doing their business.
Sure.
And I think going forward, we're going to see that we will have better profits and better results if we can keep up the pace of productivity growth. And I think Steve is absolutely right. Productivity is really the heart of what the future is going to hold for inflation.
Yeah, very, very good points there. That companies are now, and if you read the earnings calls or just listen to me give you the summary of them, what you'll find is almost every single company, I mean, even Costco, which has massive labor expenses, every single company that I'm looking at, they're not talking about raising wages. They're talking about, yes, wages have gone up, but you know what they're talking about? We are working on increasing productivity and more automation, because we believe if we can have more automation and more productivity, we will be able to make margins better. Right? That's a lot of what we're seeing right now, which I think is phenomenal. And actually is somewhat bullish. Now, we do need to look at a little bit of what T.S. Lombard is saying. They are a pretty classic traditional bear here. And, as much as I like to, put on my bullish hat, I have to be realistic. So I always pay attention to the bears. Like I say, you might be a bear, I might be a bull. I'll still have beer with you. Doesn't matter. We can have different opinions. Okay, so what do we have here? The Powell versus reality. This author argues that the idea that 50 basis points is even on the table next week, according to this bear, is a tacit admission that the downshift in hikes was a mistake. The Fed slowed, thinking they were closing in on peak rates. They are, in fact, no closer to understanding where peak rates reside than where they were a few months back, because they have no idea where disinflation will settle without a recession. February employment number, obviously, those are coming out. Here, look at this. Fed hiking cycles measured in days and rates heading into a recession. And it kind of just shows you sort of different eras here, the 90-91, 2001, 2008, 2009. And you can see climb led to recession, climb led to recession, climb led to recession, climb led to COVID. So that was weird. So what are we? Are we weird? Well, probably. Or are we going into recession? Right. That's just sort of your traditional bear case here. Anyway, here we go with this Taylor rule again. See, this is yet another version of the Taylor rule. Oh, let's look at the modified Taylor rule. Well, if we do the formula, what do we get? Oh, we need to get to a 7.7% federal funds rate. Hey, which, you know what? In fairness, everything the Federal Reserve has told us in terms of projections has been wrong so far. Wrong so far. Everything. Every time they give us a summary of economic projections, it's too low. You know, and I remember when the last summary of economic projections came out in December, we're like, oh my God, 5.1% Fed funds rate. That's insane. That's higher than even the market's pricing in right now. And the market sold off. And I remember saying, this is actually really bad because the Fed's been low on everything so far. Are they trying to get ahead, or are they going to end up being low on this again? Well, if we had to decide today, they're low again. Scary. Always wrong. Now, if we get really good labor reports tomorrow and good inflation reports next week, then maybe that's not that big of a deal. Either way, next week is St. Paddy's Day, and there's an awesome St. Paddy's Day opportunity for you. Link down below for the programs on Building Your Wealth. Remember, we don't have any sponsors on this channel, so if you appreciate that we're not talking sponsors, it's just my own products, link down below. I think that the easiest product to sell is the one that you believe in the most. It's usually your own product. So I'm a big fan of the quality and what we have there for you. But anyway, this is the second headline of today's testimony. Okay, fantastic. Hold on. There's one more piece from T.S. Lombard we need to talk about, and it has to do with the bond market. See, T.S. Lombard, continuing with sort of the bear case here, he argues that while there is some optimism on disinflation, he argues that it is a fantasy to return to 2% inflation without a recession. I do think this bear is forgetting that it just needs to be 2% average, right? I really think the Fed is just waiting to pull out the average argument. We know it's coming. We know fate is coming because, well, it's fate. Flexible average inflation targeting. Anyway, it compares basically to the inversion of the yield curve that we had in 2000, where the Fed funds rate topped out at 6.5%, but inflation was running at 2.4%. Now inflation is running at 6%. And we're maybe going to top out at 5.1. He's basically like, yeah, right. This is the same person who's like, we're probably going to top out in the 7% range. Yikes. The 1970s was the last time we actually had this misguided optimism on inflation's course and Fed policy being priced into the yield curve. Remember, though, how are things different from the 70s? Inflation expectations today. And we didn't just leave the gold standard like we did in the 70s. Does give this example for inflation basically always going away through recession, but and then specifically refers to the Korean War. But the Korean War is actually an example of a soft landing, so I wrote this on the side. The Korean War was deemed to be a tiny recession that was actually cheered as solving inflation as a near soft landing. Unemployment peaked at about 6.1%, and that recession was really called a V-shaped recovery, and it was deemed to be relatively mild and brief. So I personally love it when people compare us today as a bull here. I love it when people compare us to the Korean War era and that recession, because it was a fantastic recession. Like, if you were going to have a recession, that's the one you would hope for. However, as I have regularly said on the channel, hope is not an investing strategy. And if there's no return to 2% inflation without a recession, says this individual, then it's likely, well, actually, the individual here suggests we're going to have to see the unemployment rate rise to about 5.5%. We're probably going to see that reflected in the next updated summary of economic projections coming out on the 22nd from the Fed. He does not believe that we are going to see the world mend itself back to what it was. This is even though, as we just saw in that CNBC interview and what Jerome Powell reiterated, the disinflationary forces that were in effect in the last decade are still in effect today. That's important to remember. That's at least what Jerome Powell is telling us, and institutions are telling us, and I believe that as well, right? The disinflationary forces, whether you call it globalization or reglobalization, artificial intelligence, technological innovation, whatever. Automation, you name it. My mid-year recession call is still a 55% probability, rooted in the flip to negative carry for real inventories, leading to more layoffs, and financial services no longer being able to build on high and rising equity prices. Yeah, I'm not a big fan of financial services right now. I think they're going to get hit by lower incomes really getting stretched substantially more. But anyway, the individual here says that the 5 to 10 curve usually actually turns positive before a recession. So that implies that we should have to start seeing the steepening of the yield curve before we're actually officially in a recession, which is interesting because, what if we get the steepening of the yield curve in like June or July? Well, then it reiterates the idea that maybe we won't actually get our recession until like Q1 of 2024, right? 6 months before. So I think this is really an interesting sort of leading indicator here. Air travel dropping back to 2019 levels. I actually thought that was bullish because it kind of suggests that we had this peak of air travel and we're going back to lower levels, which is good because you put less inflationary pressure on something that's been very much inflating. A little bit of talk about how we're seeing less financing of inflation, lower loans. We saw a lot of credit being pulled in the middle of 2022, but you're actually seeing less financing happening right now. The market remains convinced that the world will repair itself back to pre-COVID levels. According to this bear, it won't. Ignore the chatter about no recession needed. I don't know that we can say that we're definitely not going to have a recession. I just think the question is like, what stocks can you hold on to that will do well through hopefully what will be a mild recession? Now, everybody says every recession is going to be mild, but so we don't know how deep it'll get. But I mean, personally, what I'm just seeing with not only the excess savings people had, not to be confused with excess savings rates, but also with wealthier folks and businesses spending through the recession, I think you could really set yourself up with pricing power stocks that'll do well through a mild to moderate recession. I don't think anything does well in a bad recession, so that is something to keep in mind. But yeah, I don't know that we have to believe in immaculate disinflation, which this individual calls a fairy tale, basically a fantasy. As long as we have a trend down and we're not getting Paul Volckered, I remain bullish on pricing power style stocks. Yeah, I really like big PP. The bigger PP, the better. I just want PP all around me. And I think that's very, very important. But this is your bear case. And I think the bear case has good arguments. I pay attention to it. I don't think those arguments are strong enough like they were in January of 2022. That's really when we had leading indicators letting us know that poopsie doopsie was coming. But anyway, that gives you a little bit of the bear case in terms of what's going on with the bears.